Hello and welcome to another one of our Macro Mondays. It's our 6th episode and let's get straight into it. We've got lots to cover with what happened last week and a couple items on what's going to be coming up over the next period. So the US Fed did confirm that they are ready to start the rate cut cycle. They weren't specific about how large the first rate cut would be, but markets are pricing in the highest probability being 25 basis points. However, it could be 50 basis points. And then in terms of going forward, we're looking at 100 to 200 basis points of cuts being priced into the market. There were some interesting comments made by Jay Powell, one being that they don't expect unemployment and the labour market continue to get weaker and the unemployment level to actually rise much further, which was quite surprising. There seems to be within the Fed, so if you look at perhaps in hindsight, they would have rather actually cut in the July meeting. And there were quite a few people in favour of actually doing a rate cut then. It'll be interesting to see labour data and economic data going forward. And I think that will be a major contributor to how large the first rate cut will be. A 25 basis rate cut would be more positive because it demonstrates that there's still strength in the economy and they're just going through the motions of actually bringing rates down. A less restrictive stance, I guess. If they start to go quite fast and quite quick, that could be a sign that they are not confident about the economy and the labour market specifically. So time will tell. We've got lots of interesting data points coming out around the labour market and GDP, etc. So that's definitely something to stay tuned for over the coming weeks, and we'll definitely report on it. But the TLDR is the US is definitely ready to cut, and it's most likely because of the softening in the labour market, and they're probably underplaying the concerns and risks around the labour market publicly because there's some interesting data coming out around revisions and such. And that really plays into the equity market, the S&P and the NASDAQ 100. The S&P is right there at a double top, just about 0.6% off of breaching the all-time high that we had mid-July. The NASDAQ has a bit more to go. They came off quite a bit more than the S&P did. However, getting closer to all-time highs once again, a higher hill to climb, should I say. So the S&P is a real interesting one, right about to breach all-time highs again. It'll be really interesting to see if it can convincingly get through those all-time high levels. If it does, perhaps there is some sort of precedence for S&P 6,000, which many people have speculated around. However, the setup's not great given the weakness in the economy and the labour market that's starting to rear its head, and the bond market is definitely shouting out for a recession. So it'll be really interesting to see. I think the equity market isn't as concerned as some of the other asset classes at the moment, especially bonds. And the NASDAQ has quite some time to go, so less likely to shoot through its all-time high, but very concentrated to technology, of course. So it did have a larger give back than the S&P because of the semiconductor and just technology in general holdings, where it did take a larger hit. This is a big one. This is an 818,000 job revision for last year in the US. It was relatively expected. We've been seeing these revisions throughout the last period, 6 to 12 months. That would take the total job revisions for last year to about 1.2 million. And this 818,000 job revision is the greatest that we've seen since the GFC. And I would say it was significant because it's much higher than most people expected. I think there was an expectation that there would be a revision of around 600,000. However, coming in at 818,000 was slightly unexpected. However, the equity market, as we saw in the previous slide, has completely shaken it off and not too concerned. So time will tell. These sort of revisions seem to be commonplace now in government data, in the US especially. So expect any initial reporting you see in the US at the moment, it would be prudent to consider it most likely wrong and most likely too optimistic, because that's what we're seeing consistently, is that these numbers come in and then they get revised down later. So any number that you see, make sure to set a reminder to go and check for revisions down the line, because it's really important at the moment to make sure that you're ahead of the revisions, because that plays a factor in how the markets react later down the line. And it just gives you a sense of being better informed. So it's always good to be aware of revisions, especially in an environment where we're seeing lots of revisions. This week we have Nvidia earnings, probably the most anticipated earnings of the year. Typically, Nvidia earnings over the last period have been the most sought after and looked at earnings reports. Each earnings report, it becomes more high pressure and more popular. So this is obviously the latest earnings. So lots of people looking at it, and everyone will make the claim that this is the most important earnings in the market. Relatively expensive on a PE ratio basis, on a price to sales ratio, also not even quite extremely expensive. Incredible sales growth and earnings growth, unprecedented margins at the moment, given the capex cycle that we're seeing. One of the largest companies in the world at 3.18 trillion. That's the overlook. Obviously, lots of concentration in the indexes for Nvidia because they're market cap weighted. What we need to be looking at here is what's the commentary around the capex spending of their major customers. Nvidia has a lot of concentration in a very small number of customers, which can create a lot of volatility in earnings and revenue. We've seen Nvidia go through these cycles of revenue and earnings growth before to then retract, given the cyclical nature of the business and capex cycles. So once these large companies do huge capex cycles, it's expected that they would tone it back and then later perhaps go on another capex spending spree. Another data point to look at would be how they're looking in terms of the delays of the next chips. I think that's actually not too important. It gets a lot of hype and a lot of people talk about the delays. I don't think delays would be significant in terms of what's going to actually make the stock price move on or into earnings. Typically, if you look at what happened to Cisco back in the day, it was when they slightly missed on the earnings. So margin compression would be a big risk to Nvidia. That would be potentially the start of a trend that investors wouldn't like. So definitely be watching out for the earnings numbers and growth. Continued capex spending and how they're feeling about their customers will make quite a large impact on how investors are likely to react to the earnings. And then, of course, their forward guidance in general is definitely something that many investors will be looking at into this report. So a difficult one here. We're looking at a double top. Potentially, they are extremely expensive from a fundamental perspective. It's one of those things where being on the sideline and not having skin in the game might be a more relaxing experience, to say the very least. Exposed to a squeeze and a pump of the stock, definitely into earnings. It's the sort of market where you could see a big move up. And then obviously from the other perspective, if any of those forward indicators that investors may then extrapolate out don't hit that perfection number, then the stock could be extremely volatile to the downside too. And then on the last perspective would be, well, there's going to be a lot of people betting on both sides. Market makers may win and it ends up pretty flat from the Wednesday report to the end of the week. So definitely wanted to tune into on Wednesday US time. So Wednesday after hours US time is when they're reporting. Definitely one to watch out for. So commodities this year. Commodities are an interesting set of assets to survey at this point in the cycle. Lithium, LIT, which is the blue line, has got smashed over the last year, down 30% in line with the EV car maker trend that has been doing as an industry quite poor over the last year. Your standard economic assets, which would be oil and copper, creating a bit of a divergence here. Copper's been getting a bit stronger. Oil's been relatively weak. However, we've seen a little bit of uptick in all the commodity over the last week. That could be due to the US dollar getting slightly weaker with the prospects of rate cuts and potentially some recession fears. Gold, though, which is orange line, it continued to be strong and maintained good strength with relatively low volatility as well. Definitely talks to some of the more geopolitical concerns, some of the concerns with the US dollar being so strong, and a bit of a safe haven play, which many investors are participating in and speculating over. And then the last asset in this list would be URA. These are all ETFs, by the way, trading in the US markets. URA, which is the uranium ETF. There's a lot of speculation around uranium and nuclear plus nuclear fusion. So that would explain the price volatility with uranium over the last year. So lots of speculative action around the concept of nuclear and fusion. That will most likely continue, especially as it plays into the AI narrative of not having enough energy, and many AI CEOs and stakeholders that are in the hyperscaler space or in the deep tech AI space are talking quite extensively about the energy issue connected to ramping up the AI dream of AGI and artificial superintelligence. Basically, the concept is we don't have enough energy to handle the demand when it comes to AI. That could be a bit of a marketing gimmick from the AI CEOs because we actually haven't proven how much demand is required for AI, like the true demand of consumers paying and businesses paying and generating revenue through AI. So in terms of the long-term adoption of AI, it makes sense. And in general, there's a lot of fragility in the US and around the globe around the grid and energy independence plus energy stability as we just naturally use more energy as a civilization. There's a whole episode on the density of energy creation as well and how that's deflationary. So nuclear fusion would create much more density in terms of the energy able to be created. Whereas if you look at something like solar, the density of the atoms required to generate energy on a kilowatt hour basis is extremely inefficient. So from a technological standpoint, you would like to see more density in terms of being able to create more energy per kilowatt hour. And solar, for example, although it's getting better and better, it is nowhere near. Nuclear fusion has the potential to be extremely dense in terms of the amount of energy it can create, especially with some of the micro designs that we're seeing coming out of the industry. But the adoption hasn't been widely held. There's obviously a lot of lobbying going on, both from clean energy, solar and wind solutions, and of course fossil fuels. There's naturally going to be quite a lot of pushback, but the potential is quite profound. Definitely fits the long-term narrative. However, over the short term, the uranium price moves are most likely speculative or generally following the trend of other commodities as potentially the US dollar weakens. So interesting to watch. I'm most interested by how oil continues to react. If there is a recession in the US and globally, then you would think that oil would be put under quite a lot of pressure. However, it's a very scary place to be because with all the geopolitical dynamics, there's just that tail risk of an oil shock at any given moment. So more of a watch and see and try and work out what that means from an economic standpoint. Thank you once again for listening to our Macro Mondays. We do these every week and we'd love for you to like and subscribe so that you get notified when we do our new episodes. Of course, as always, these Macro Monday episodes are for information and entertainment purposes only. None of the content construes buy, sell, or hold recommendations of any asset of any type. We are just commentating on the news flow and some of the dynamics that are going on in the marketplace and bringing real-time and current events. We look forward to you joining us for the next episode of Macro Mondays. Have a great week.